Picture this. You are 53 years old and your tea is hot. That sounds like nothing, doesn't it? But you need to understand, hot tea on a Wednesday morning with no rush, no soul-crushing commute and absolutely nowhere to be. That is the entire point. You are sitting in your back garden, watching your neighbour, an accountant called Marcus, reverse his car out of the drive at exactly 7:45 for the daily grind. You used to watch him and feel a sense of shared misery, that specific hunch of the shoulders when you climb into a freezing car, knowing the day already owes you an apology. But not anymore. Marcus doesn't know what you do. The bloke next door thinks you consult for some tech firm. His wife reckons you must have a trust fund. You don't have a trust fund. What you have is an investment portfolio generating £124,600 a year in completely passive dividend income. You didn't build an app. You didn't take massive risks on crypto. You didn't inherit a single penny. You started with just £800 a month. But here is the catch, and it is a massive one. To get to this seat in the garden, you have to avoid a silent, devastating trap. It is a trap that catches roughly 9 out of 10 people who try to build passive income through dividends. If you stay with me until the end of this video, we are going to reveal exactly what that trap is, why the people chasing the highest returns are usually the ones who lose everything, and the precise year-by-year maths required to make this reality yours. Welcome, I am Amara, and this is Quiet Wealth. If you are tired of the flashy, unsustainable noise of the financial internet and want to build real, lasting freedom, make sure to subscribe. Now, to truly understand how to avoid the trap that ruins most investors, we have to go back to where this all started. Age 24. You are living in a drab flat with that specific, depressing yellow overhead light that every cheap rental in this country seems to have. You are earning £32,000 a year. It feels like it should be enough. But when you sit down and actually do the maths, it is terrifying. Rent, student loan repayments, council tax, groceries, and an energy bill that is somehow always higher than you expect. Before you have even bought a pint or done anything you actually want to do, the money is gone. You are saving genuinely almost nothing. Then, one Thursday evening, the YouTube algorithm finds you. You see a thumbnail of a bloke sitting on a balcony in Portugal holding a glass of wine with text plastered across the screen. I make £8,000 a month from dividends. Here's how. For 3 days, you are completely obsessed. You are mentally already on that balcony, shopping for linen shirts. But then you actually start reading, not watching, reading, and you discover the truth. Here is the secret the bloke on the balcony was not telling you. A company paying you a 10 or 12% yield on your investment is, in many cases, paying you that money because it is in deep distress and has nowhere better to put it. This is the payout ratio trap. If a company earns £1 per share and hands out 90p of it as dividends, it only has 10p left to grow, update its technology, or compete. It is returning capital instead of reinvesting it. It sounds generous, but it is actually a distress signal dressed up in a bow. These are the yields that look irresistible on a thumbnail, but collapse in real life. The dividend gets slashed, the share price follows it down, and you are left holding a stock that has lost you money on both fronts, income and capital. The sustainable approach is completely different. To generate roughly £120,000 a year in dividend income, you don't look for double-digit miracle yields. You realise you need a portfolio worth approximately £3.25 million, built on a realistic diversified yield of about 3.8%. Not 9%, not 12%, 3.8. You need companies, or more precisely funds holding companies, that have been paying and growing their dividends for decades, with payout ratios that leave room for the business to actually have a future. £3.25 million sounds like a joke when you are 24 and skint, but you have one thing working for you that no amount of money can buy later: time. And time, when applied to compound growth, is genuinely unfair in your favour. So you open a stocks and shares ISA. You start investing £800 a month into broad diversified dividend ETFs. In year one, you have about £9 or £600, generating roughly £30 a month in dividends. You reinvest every single penny. You do not tell your mates at the pub. because frankly, there is nothing exciting to say yet. £30 a month does not get anyone's pulse racing. But here is what most people miss, and it is genuinely the most important thing I will say in this entire video, that £30 a month is not the point. The point is that those reinvested dividends are buying more shares, and those shares will pay their own dividends, and those dividends will buy more shares. It is a loop, a compounding loop. And in the early years, it moves so slowly you will question whether it is doing anything at all. But it is. You just cannot see it yet. Let us talk about what this actually looks like year by year, because the psychology of this journey matters just as much as the maths. You get a pay rise at 28. Nothing dramatic, but enough to nudge your contributions up slightly. You get a proper promotion at 32, and you bump your monthly investment up to £1,500. By the time you turn 30, your portfolio sits at roughly £94,000. That is 6 years of not buying the flashy car, wearing the same 3 pairs of shoes, and politely nodding when your colleagues talk about their massive kitchen renovations. That £94,000 is generating around £3,500 a year in background dividends entirely on its own. It is not enough to live on, not remotely, but it is real. The machine has started to breathe. But people always ask me what the hardest part is. They assume it is the initial sacrifice, the early years of putting money away when you would rather spend it. It isn't. The hardest part is the boring middle years, between roughly ages 35 and 45. This is the period where you have enough money in the account to see what it is becoming, but not enough to feel totally secure. It is like standing in the middle of a river, with neither bank visible and having to just keep swimming. You can see the destination on the spreadsheet, but you cannot feel it in your daily life. You are still going to work. You are still budgeting. You are still making sacrifices. And the compound curve, which looks so dramatic on a chart, feels completely flat when you are living through it in real time. You actually lost a relationship in your mid-30s, partly over this. She was not wrong to want a different life. She wanted to buy a bigger house sooner, take lavish holidays, and stop optimizing every pound for a future she could not picture. You would not stop. You told yourself it was discipline. Maybe it was also rigidity. That is a cost that does not show up on any spreadsheet, and I think it is important to be honest about it. Building wealth over decades requires trade-offs that are not just financial. They are deeply personal. Now, remember that trap we talked about at the start? The payout ratio trap that ruins the vast majority of impatient investors? Around age 40, it comes for you directly. A bloke at work called Phil from regional sales pulls you aside one lunchtime. He is vibrating with excitement, showing you a stock on his phone yielding 9%. 9%. Phil thinks he has found the Holy Grail. You ask him what the payout ratio is. Phil goes quiet in that specific way people do when they realize they do not know what a word means, but they are too proud to ask. You try to explain to him that markets are not charities. If a yield looks too generous, there is always a reason. The company is either borrowing to pay that dividend, running down its reserves, or the share price has already collapsed so far that the yield only looks high because the denominator has shrunk. Phil ignores you and buys the stock anyway. 18 months later, that company slashes its dividend by 60% and the share price plummets with it. Phil stops bringing it up. You never say "I told you so," because there is no point. But you note it. You file it away. And it reinforces something you have believed for years. The boring path is the safe path, and the safe path is the one that actually gets you there. Let us talk about diversification for a moment, because this is another area where people get it badly wrong. Most people think diversification means owning a lot of different individual stocks. It does not. True diversification means owning different types of assets that do not all fall at the exact same time. You hold hundreds of companies through broad ETFs, consumer staples, healthcare, utilities, industrials. If one company cuts its dividend, the fund barely notices. You are not betting on any single business to keep paying you. You are betting on the entire economy to keep functioning, which over any meaningful time horizon it always has. By age 45, your portfolio crosses the £500,000 mark. The dividends alone are now generating over £20,000 a year. You are still reinvesting all of it. You are still going to work. But something has shifted psychologically. You can feel the compound curve starting to bend upwards. The growth from this point on accelerates because you are earning returns not just on your contributions, but on decades of accumulated returns. By 50, the portfolio is north of £1.5 million. The dividends are approaching £60,000 a year. You start to allow yourself, very cautiously, to imagine the end point. You run the numbers again and again, stress testing them against different scenarios. A prolonged market, downturn, higher inflation, dividend cuts across the board. The maths still works. By 53, the portfolio sits at just over £3.25 million. Your annual dividend income is £124,600, with a safe blended yield of 3.8%. You hand in your notice on a Tuesday. Your manager looks more upset than you do. You feel almost nothing. Just the quiet sensation of closing a browser tab you have had open for 29 years. Click. Gone. Over 29 years, you contributed roughly £700,000 of your own money from your salary. The rest? That came entirely from time, compound growth, and dividends reinvesting into more dividends. Your money made far more money than you ever did. Now, you live off 70% of that income, about £87,000 a year, and the other 30% automatically reinvests to keep the machine growing and to protect against inflation. You have no mortgage. You have no debt. Last spring, you sat on a balcony in Lisbon, looking out over the city with a glass of wine, finally becoming the person in that YouTube thumbnail you watched in your 20s. Except your version is real, sustainable, and entirely yours. On Wednesday mornings, you volunteer at a community centre. There is a 23-year-old lad there, sharp and sceptical, who asks you about money. He wants a shortcut. You tell him the truth. There are no shortcuts. You teach him about the payout ratio trap. You tell him to put what he can afford each month into diversified ETFs and to use his ISA allowance every single year. He asks how long it will take. You look at his impatient 23-year-old face and give him the honest answer, late 40s, early 50s if he stays the course. He goes quiet for a moment. Then he asks if he can bring a notepad next week. You smile, because that question tells you everything you need to know. He is going to be fine. There is a thing that happens when you watch a number compound over decades. It rewires your psychology. You stop thinking in weeks and start thinking in years. You watch the market drop 20%, and you hold perfectly still because you finally understand, not intellectually but in your bones, that selling into fear is the only move guaranteed to destroy you. People talk about passive income as though it falls from the sky. Nothing about those 29 years was passive. It was a slow, unglamorous grind in spreadsheets, whilst everyone else was buying things to show off. It required patience that bordered on stubbornness, discipline that occasionally cost you personally, and the ability to sit with uncertainty for years on end. But the income is passive now. That part is true. You did not win the lottery. You did not find a secret market. You just started, kept going, and tried really hard not to be stupid about it. And the ultimate reward is not the money. It is the total ordinary freedom of a Wednesday morning with absolutely nowhere to be. If you are at the beginning of this journey, or even if you are trapped in that difficult middle stretch, I want you to know the maths works. It has always worked. The only question is whether you have the patience to let it. I am Amara, this is Quiet Wealth, and I will see you in the next one.